Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, July 14th, 2020. Interesting day. I actually couldn't wait to do this video at the end of the day. Just kind of cover some levels, development, everything that went on today. Some things to point out, but it won't be a super long video. I know I said that sometimes. We'll keep this one manageable. Just start out here with SPY. You can see, interesting enough, look where they parked it, right back at resistance, the top of that multi-week trading range right there, right where we've been, capping the last few days. We had that false breakout above the range yesterday. Moved back into the big reversal intraday, and today it looked like we had some follow through to those sell signals, at least the bearish engulfing candles that we had yesterday. But then they ramped it, not ramped it. I wouldn't call this a ramp at all, but they did buy it at they bought up the open. If you can make out here where the crosshairs are, that's where we opened today, right there. You can see 4 p.m. close right here. That's where the crosshairs are. So we were red most of the day. Here, let me show you what we're looking at. This is a 1 minute chart, by the way, guys. The yellow line will show you yesterday's close right here. So anything above there shows we're negative. So most of the morning we started out, had a little kickback to go slightly positive, and then looked like we're heading lower. Hit those supports on the futures that we were at this morning, and then they've stepped in and started buying it from there. So a decent reversal, nothing mind-boggling, especially compared to what we've seen lately, but nonetheless they stepped in and bought the dip. They turned it green, closed it green today, and as I said earlier, that's really one of the most important things. Not that we followed up with a little downside today, but how you close the day. So I'll just make it very clear, and then I'm going to go through the charts. If you're a bull, then you would have bought the dip, like I said today. Nasdaq was down. What did I say? I think roughly 7%, over 6-7% in the last 2 days, and that's about in line with the previous correction. So let's step in and buy. There was support we were at earlier today. Now, if you're a bear, shorting, expecting more downside, that's where I'm at. I told you it's not an all-in short moment yesterday. Just because you have a bearish engulfing candle, you don't go shorting the boat when you're in such a a resilient uptrend as we've been. Again, I've said this for a long time. The market, the S&P 500, this is the stock market, if anything. It's not going up anymore, at least for last month, but it's not going down either. That's a resilient market. And if you take a step back, the trend off the March lows has been bullish. So, if you want to say, well, who's in control, then you have to say the bulls, because the bears can't take the market down, or the sellers, speaking metaphorically, of course. However, bigger picture is this, and you say the bears are in control, if you want to say that the S&P stock market, the Dow, the mid caps, the small caps, every other index except the undiversified Nasdaq 100, they're still well off their highs. So again, let's not play that game of semantics. We're close enough to those highs, and the trend has been resilient. So right now, you're going to have to say, it's the onus is on the bears to take it down and to take the market down. And so far today, they failed to capitalize. And again, guys, I speak metaphorically, bull bear. I'm talking about supply and demand forces, selling forces, buying pressure, and all that tells us is, despite yesterday's bearish price action, more buyers stepped in and bought the dip today, which is the norm. However, everything that I said before is still in place. We still have negative divergence for the first time since this 35 or 6% drop. First time we have divergence on the daily chart. And although they managed to buy up the dip today, they didn't take it back above the top of that trading range. So we closed right at resistance. So I'll say what I said on, I think it was Thursday of last week, maybe Friday, maybe both days, that it's still an objective short entry here. However, if you already took a short position, or if you've had shorts you came into, with today's price action, I didn't see what I wanted to see to add to any short positions. So if I didn't have any today, and let's say I was on vacation mode and I just got home today and I was waiting to see how we close, I would hold off and wait and see another day. Like I said, it's subjective. You can do it if you have traderitis, but the fact that they the bears, so to speak, couldn't follow through to yesterday's price action. It doesn't give you that check mark you needed. If anything else, the bulls get a win for today by turning it around and taking a red day that we started out and closing it comfortably in the green. So that's S&P 500. Look at the 60-minute chart. Interesting enough, when I did the video early today, I showed you this was my original trend line right here for the SPY, and I told you I had dragged and modified this one down here, but I was going to leave that one up because that one I think is the better fit. By that I mean it had more reactions on more candlestick bodies and or shadows, and that comes off the low right here on June 29th. And so I'm going to eliminate this one now. I'm going to go back to that original one I had and show you what I see. Basically, I see a rally back to, I see a breakdown, impulsive breakdown. That's certainly what you want to see, a big red candle through there. And I see a kickback. Talk about breakdowns, and I'm referring to this bearish rising wedge pattern here on the 60-minute chart, which was complete with negative divergence. So this I can say. Right now, we still have a sell signal in play. We have a breakdown. Sometimes you break down and that's it. You bounce off support. Nothing goes straight down forever. And sometimes you break down and you backtest the breakdown level, the support level. In this case, it's the uptrend line on the wedge. So that's all we have today in a very simplistic view. It's the same trend line I was looking at last week and earlier this week. And we rallied right back to it. That 318.77 level. Look, we closed at 318.89. On a 320 point security. That's almost a perfect close right on the resistance level there. And that's going back here. We have a bunch of gaps. We have gaps back here, gap a little bit above it there, and so that's it. So like I said, it's not to me a hard all-in short yet. And if you're a bull, what you want to see tomorrow is that trend line regained, especially on a solid close. Even a 60-minute close would probably do the trick. They might pop it intra-period. What does that mean? Well, when you see the skinny part, that is called the shadow up top, means they were able to get up there. There was a lot of momentum heading into the close, but there was a little fade towards the end or at some point in the last hour of trading today. That's why the body, that shows you we closed at the fat part where the candlestick body is. So that's it. Breakdown and a back test to be continued. You can see it also takes the form. It's getting a little bit big in relation to the flagpole, but remember last night we had those bear flags on the futures, which broke down today, this morning. Well, we didn't have it on the SPY and QQQ because again the futures continue to trade around the clock. But we have now what may be, again, it's a little bit big in relation to the flagpole. This is your flagpole. You could say it's a bear flag. Again, it's stretched. What you want to watch for is the essence of the pattern is the same. You have a level of consolidation, and you have a little trend line there. So a break of that trend line, ideally it would have to happen soon. And remember, it's not going to happen today or tomorrow. The market's closed right now, and I'm not showing you the after-hour trades because that's all that matters here is what happens in the regular session when we're looking at these two. So should we gap down tomorrow or open and then move down through there? This is still our first support. I mean, that was a story today. 312, very good support level on SPY, and the buyer stepped in. Why is it a very good support level? Well, look how many reactions. We had numerous candles back there. We have a gap, a very super technically significant gap. That was that big sell signal back there, June 11th. That's the bottom of the gap. We danced around it. If you look, a lot of another gap there, another gap there, another gap there, and then reactions since we gapped up, several tests of that level, including today. So to me, this is the number right here, 312. Bears need to take out 312 this week. If they could do it tomorrow, all the better, because like I said, they failed to capitalize or follow through today. And of course, bulls, they can just continue to walk it up. Then what they did is they just wiped out what could have been a decent sell signal for the bears. And so that's what you want to see if you're bullish. And if they go up much more, they're probably going to take out that high. Yeah, there'll still be divergence for a while, so it's not the be-all, end-all. If we happen to have another green day tomorrow, we'll see if these divergences remain intact. I just extended the lines, so that's what I'm looking for on SPY. QQQ. Remember, it's all about tech. That's the big one. Well, here's the 60-minute chart of QQQ. This morning, as I was doing the video, I believe shortly after the open, we had fallen down right here to this first support zone. When I have two support levels in close proximity, I refer to that as a support zone. That's a support level, about 247. This is more of a zone. These two are together. So this one, the first one, comes in around 254. That's the top of these candles, as well as this gap right here, and maybe some things to the left if I go back far enough. But so there it is, big breakdown, sell signal, and this bear flag looks a little bit more symmetrical, relative to the pattern. So there's your bear flag. Impulsive move down. I'm sorry, flagpole. There's your bear flag. This is what the bears want to see tomorrow. Whether it comes, whether we open open flat and then move down, or we gap down. Remember, a gap, you're not going to see any candles there, but it's going to be the same net effect. In fact, nothing is more impulsive than a gap down. I mean, here's a big red candle, certainly impulsive, but if you have a gap, it's the same thing. You're just going to see black there because the candle is going to start down tomorrow. So that's what we'll be looking for, and that would give another check mark to the bears. Any kind of gap down like that, especially if we could gap down below that 254 support. That probably take us right down. My guess would be maybe a little blip along the way, but take us down to that 247 level. And if you want to kind of get an idea of what a near-term target might be for a bear flag pattern, here's how I do it. You take the flagpole, measure it out with the trend line, and either click on that and create a parallel trend line, or just take that one, drag it down, add it to the top of the flag. So this assumes that we break down tomorrow and we don't go any higher, that we either gap down or open flat and move down. And you can see that would take us right down here to about that, beyond that 246, 247 target right there. Although what I do is, if I'm trading a pattern and I'm using the measured target for it, and I have a pretty decent support right there, and I have one right here, well, if I'm actively trading, I'm going to give the benefit of the doubt to the first one, because the buyers may step in there. I think that's where we would likely get a reaction, again, if there's any more downside tomorrow. If they open it and go up much more than that, well, what you've done is you've foiled this potential bear flag pattern. Now, there's still a trend line that's comfortably above, and that's why I said with SPY, for example, we could see the same thing on QQQ. We can see some more upside. I'm going to show you what it might look like all the way up here. There's a gap right there. That might be gap resistance. You could stop, or let's say we rally all the way up to backtest the trend line. What would it look like? Well, the divergence is still very much intact, so I'm going to extend it out here, and it would look something like this. You rally up, you'd have the RSI do this, PPO do that, prices do that. So that is one possibility. Anything much above that would be, in fact, it all depends on where you backtest. You draw that line out there. To get another divergent high, you'd have to actually take out that previous high. So all I'm trying to do is give you a range here of where the bears need to keep this in, and that is anywhere either slightly above this level. In other words, if it took a little while to backtest, if it took a day or two, a few days even, like this, somewhere up in here, if I could get the right drawing tool, there we go, something like that, and you would take us slightly above there, extend the divergence like I showed you down here, keep it intact, and then reverse. Anything much above that, there's no way to spin that as anything but bullish. Doesn't mean that we're going to go to the moon, but it just means that they've stepped in. And by the way, even if you do this back test, what it's going to do there, it's going to undo these bearish engulfings. Going back now to the daily chart. This is the bearish engulfing candle on QQQ. And I said what ideally you want to see is a red candle follow up. They had the potential early on. This was red, but see, this is why I say it's a daily chart. All that matters is how you close the day, and the Qs managed to close the day up 0.71% and print a green candle. So it's a sign of non-confirmation. It doesn't negate this. Like I said earlier today, I believe, typically there's no hard rule, but I don't want to see, when you get a bearish engulfing, ideally you really want to stay below halfway, no more than 2/3 up of that candle. And most certainly if you take out the entire candle, then you've defeated the whole point of a bearish engulfing candle. That should be the topping stick. That should be the last stick. It engulfed the previous couple candles here. And again, so the ideal scenario, if you are short or if you plan to add to shorts, would be a gap down. And I say that because sometimes I talk about when a sell signal is triggered, how it's objective to short on a kickback to resistance. And if I didn't make that clear already, I'm not as keen now. Even if we backtest that level on SPY or the trend line on QQQ, keep in mind too, going back to SPY, any more upside tomorrow, it's taken us once again above the top of the recent trading range, and so we may get a sustained breakout there, and that's why, again, the ideal scenario, for the near-term bearish case is to move down immediately tomorrow. Without going any bit above today's highs. Also to take out this recent cluster of candles right there. That's kind of, we have the bigger trading range here and here. That's that shaded box. And then you have this smaller range here. So bears want to see that, bulls want to see that. And like I always say, it's all about tech. The market's not going to go anywhere without tech breaking down. At least I'm what I'm saying. It's not going to go very far to the downside with the tech sector holding up. And again, it's not because people love tech. It's simple mathematics. This is 1/4 of the returns in the S&P 500 by large, biggest sector. So it's going to be pretty tough and very unusual to see all other 10 sectors in the S&P dropping in order to offset a rising, tech sector. So that's it, and you can see that's what we call a stick save right there. A beautiful stick save. There's the purple trend line I was talking about earlier. We were below it. What happened? Well, when they opened up, they did what they've been doing for a long time. They bought the dip in the tech stocks. Again, this was our close, this yellow line. You can see here we opened the day right here. There's our open right there. This is yesterday's close, so we were red early on. The bears could have took the ball and run, and they didn't. Bulls stepped in, and again, I speak metaphorically. It just means there was more buying pressure. They bought the dip, and they actually closed it positive today. What they did do, they managed to regain the trend line, so you're going to give the bulls a check mark there, and the bears an X if you want to. But they didn't take out this candle yet, and although I prefer to see a follow-through red candle, another one, it's not at all unusual to see a bearish engulfing one green and then you start to move lower. Again, if we go up much higher, you're going to get another check mark for the bulls because they're going to wipe out that potential topping candle. The potential because we still don't have enough confirming or follow through evidence to the downside. Plus, this trend line was regained. So that's that. This is something we need to watch tomorrow. Keep it simple. Pretty much a break at today's lows should do the trick because it'll get us back below the trend line. And it'll fade all of today's gains, all of today's gains. Okay, and zooming down just a bit to the 60-minute time frame on XLK, you can see, like most everything else, we had negative divergence. Actually, it's been building for a while. It's been roll back in time here. These divergences have been building, but really a focus on these most recent divergences here. Those other ones are what you see on the daily time frame, the divergences, these longer ones here. This was our most recent 60-minute divergence right there. PPO has crossed into negative territory, but we've had a few whipsaws there where it's done it before. You also have that flagging action right now on the 60-minute chart. Again, the market's closed, and I don't have the after-hours trades turned on. For that reason, want to see what happens tomorrow. After hours can be a little whippy and doesn't always mean a whole lot right after the closing bell. So that's it. Looks like a breakdown would take us right down there to that 101.75 target, and I will say I favor that. It's just, like I said, not an all-in short entry, all-in point in time, but I'm certainly comfortable and prefer to be short right now, leaning that way. And if we start to move up, we take out the flag, we'll have a little trend line here. If they backtest that and then some, you're going to get the PPO back up, and there's potential they can burn through the divergence. But that would be, if you're trading XLK, my target. I would say down here to this range, about 101.75 to 173. Yeah, about a 1 point range, 175 or so. And that would be about another 5 to almost 6% drop if we get it. Here's that QQQ 60-minute chart. I just wanted to go back to that. I've been harping on all these divergent highs and corrections, and how they come in almost these regular cycles here: correction, divergent high, correction, correction, and they're all very comparable in in how far they pulled back. Like I said, I'm running about 5, maybe 6% on average, and turn all the lines off here. And as I mentioned, this one was about, I think I said 7 before, if I remember right, measuring it out. Or no, 6.3 off the top. And again, that's in line. Here is one of the bigger ones. I think this one might have been 7, 6.5, close enough. And you could see they're very symmetrical. No, they come, in these, almost predictable cycles. More so, it's simple. If you want to, you can't count on one coming, but adding in all the lines that I just took away a second ago, that gives you the clues to when to trade those pullbacks. Divergent high, especially when you get a trend line break. You're not going to milk all 6.5%. So where I'm going is, that may be it, and I'll caution you too about, jumping the gun on a bear flag. It's a potential pattern, but you can see, for example, back here, and some of these corrections, you had the same kind of impulsive move down, and you had flagging action. And I probably would have pointed some of those out at the time, but they didn't play out. What happened is you were flagging, and then you just kept going up. Part of a bear flag, like any other pattern, whether it's a bullish falling wedge pattern with prices doing this, head and shoulders pattern that does this, you have a trigger. On a head and shoulders, it's your neckline. It's a potential pattern, a potential topping pattern, pending a breakdown or a sell signal. Bullish falling wedge is a potentially bullish pattern, but it means nothing if you don't break out. That's when your buy trigger comes. So same thing with these bear flag patterns. They're easy to recognize. Some materialize, some don't. What you want to see ideally is an impulsive breakdown below there and follow through, and it should look, the move out of the flag should be very similar to the impulsive nature on the flagpole leading up to it. So that's what we'll watch for tomorrow, and we'll do the futures, and I'll wrap this up. Here's NQ. Let me tighten this chart up a little, zoom in a little bit. When I started the video this morning, we were right about here, just a hair above that 336. It was more of a support zone. We were right above the top of it. And at the time, we were still going down, so we didn't see. There was some divergence forming on the RSI. So we had positive divergence on the RSI, not on the PPO, and that's worth noting. Like to see those divergent lows. And again, impulsive move down, the breakdown below the trend line. And if you're a futures trader, I can put a line right here. Let me put a horizontal level to give you the number, because I think we're at resistance right now. Let me do that for you here. Horizontal line, that'll give me a price level right about there. Let me just show you what I'm looking at. I see a reaction high here, reaction high here. We danced around that level here, had a little quick spike through it, and then started respecting it again, and lately that's what's been capping everything. I put the highest weighting on the most recent price, but it helps when you can see traders have stepped in there before as support and resistance. So 10,672, we'll call it. Anything much more than that, then you still have the trend line to contend with, as I went over on the QQQ and SPY charts. Maybe we come in for a back test. So, if you are looking for a place to short, and this is objective right here. If you're also looking, next level would be a back test of the trend line. If you're a bull and you're looking to, go long, well, same thing in reverse. Break above there, and then a break above the trend line. And last but not least, we'll wrap it up here. This is ES, the S&P 500 futures. In the video shortly after the open today, we were right here. Pretty big level, well defined. Lots of reactions on that. It's a level I've had on this chart for a while. 311.14, we were a hair above it. 311.14 and change, really. We were just above it. At the time, we hadn't turned up. The PPO was pointing lower, so I didn't note or point this out. But after reversing, shortly after I did the video, we did get positive divergence there. It was confirmed with a bullish crossover right here on the PPO. So you have both the PPO and the RSI making higher highs, prices making lower lows, and technically that was a catalyst. It was a combination of two things. It was a drop to support, and again, one of the biggest drops that we've had in weeks right now, not even maybe in months, at least over such a short period of time. So we're very, very near term. When I talk 5-minute charts, 1-minute charts, even 10, 15-minute charts, we're oversold. And oversold near term at support with divergences, and that's what I believe was the technical catalyst for this bounce here. Now, where are we now? We had some late day buying, a little momentum, so I think that was I'm gonna, for at this point in time, consider that a momentum fueled overshoot. I'm talking about this pretty strong advance late in the day to carry us right above that 31.75.25 level. ES trades in quarter point increments, and this charting program won't snap to the quarter points. I wish it would, but so you round that off. And either way, we're a little bit above that. There's a little minor support right here. You can see there was a little minor support shelf there, so call that resistance, and that's it. So now, yes, sometimes these small divergences are the start of the next leg up, so that's something we'll have to wait and see what happens tomorrow, and that's why, again, I'd kind of keep things a little bit light right now, and especially on the short side. There's another line I wanted to add, and remember the bigger picture says, although small divergence there, we're coming off that a big diversion high, one of the biggest divergences that we've had in a while. Actually, the PPO divergence only starts right here, and there's the RSI divergence. So that was a little wedge I talked about there, but there was that larger divergence there on the RSI that I just drew out. So there was your little bearish rising wedge breakdown yesterday. Second leg, a little consolidation, another leg down, but they really stepped in and bought it hard. These were those potential flags, and they kind of got all mucked up, so they never played out to their projection right now. So those are the levels to watch on the way down. Probably the biggest one, again, would be today's lows, or just below it, 311.14. Bears want to see that level go. If so, I think we'll probably come right on through 30.80. And probably move on down here at minimum, again, if we can get a reversal. Other than that, maybe yesterday was a one-day wonder, and so if we see this overnight, a continued lift, like I said, there'll still be some divergences. Remove this line real quick here and show you what it's pretty much the same thing I already drew on SPY and QQQ. Should we push up, make a marginal new high, and then reverse? Marginal meaning slightly higher over that previous high, then there's still the potential to keep the divergences intact. Let me draw those lines. This would be your divergence line right here. Divergence line, and same old. Really just extend this divergence that's been building there, or this one here as well. That's that. Not as good for the bears to see that happen, although it still gives potential. Bulls, again, market's an uptrend. You buy the dip. You bought the dip today. If that happens, then you're off to the races. I don't favor that scenario. I favor that we probably saw the end of this first counter trend rally. Keep it very simple, and then we'll wrap it up here at that one leg down. We'll call that maybe a zigzag counter trend rally in this. Either way, the charts have been kind of sloppy lately, and you can see that again, the much bigger picture, if I go back here 3 months now, is that we're chopping around sideways in this range here. We had that little false breakout like I showed you on SPY, and we're back to the top of the range. So we're at resistance. That's where we ended the day. Let's see what happens tomorrow, and I'll pick it up in the morning. This has been Randy Finney with Right Side of the Chart. Have a great evening.